We all pay enough tax in Canada, and as a matter of fact, most provinces, the highest marginal tax rate is already over 50%. In BC, 53.53% is the highest marginal tax rate, very similar in Ontario as well. And unfortunately, when somebody passes on, all of your assets are deemed disposed of and taxed. And they are taxed on top of your other income that you would have received in the year of death. So any CPP OAS, any pension income, any RIF income, any investment or rental income would be fully taxable. And on top of that income, all of your assets would be, as I said earlier, deemed disposed of and taxed. And for vast majority of Canadians, you will have, or most Canadians will have, the highest taxable income in the year of death. We have posted another video that deals specifically with estate planning, estate liability, and probate planning, and we will post a link to that video right below. But your most expensive asset will be your RSP or a RIF. And by the way, there is no difference as far as taxation between an RSP or a RIF. Any withdrawals that you make out of a RIF or an RSP will be fully taxable. Worst case scenario is to have a substantial market value left in your RIF when you pass on, and in that case obviously you would be kissing half of your RIF goodbye, so to speak. So one of the most common recommendations is to try to melt down your RIF during your lifetime. So right after retirement, even if you did not need any funds to fund your retirement, you should be going into your RIF and just withdrawing from high tax environment, possibly if your TFSA is not maxed out, moving assets into your TFSA, or just moving assets into a non-registered investment account and investing at a lower tax bracket there. You could also consider insurance, life insurance, to reduce your estate tax liability, since insurance contracts are one of the only things left in Canada that are actually tax-free. So it's insurance contracts, it's your principal residence, which you would already have, and it's a TFSA. So those are the only things really left in Canada that are tax-free. So make sure your TFSA is maxed out, and it should be one of your last pools of capital. Your principal residence, that's fantastic. And as I said earlier, consider insurance to reduce overall estate tax liability. Now, the other strategies you could consider is you could trigger capital gains in your portfolio, or if you own rental properties, start selling rental properties while you are alive. Because again, the worst case scenario would be that all of these capital gains are triggered all at once in the year of death. So if you have multiple rental properties, you could consider selling one or two of those properties, and if practical, you could actually consider gifting these assets to your beneficiaries while you are still alive, because Canadians are living longer. Life expectancy is age 80 plus. So it might be, for a lot of families, it might be more practical for these beneficiaries to leave these inheritances while they are in their 40s versus 50s or 60s. By that time, they're usually set and will not need the extra $500,000 or $1 million or whatever it might be. Those are the basic strategies that Canadians should consider to avoid leaving a nasty tax surprise. But the number one recommendation is to make sure to have a will. If you do not have a will, please get a will. If your will has not been reviewed in a long time, at least every 5 years, so your will should be reviewed. If you have further questions, please send me an email or please give us a quick call. And also please subscribe to the channel and like the channel, and see you next time.